a.m. in New York City. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Traders paring back rate cut bets following that payrolls report. Jobless claims up next. Stocks recovering from another AI scare trade, while Anthropic inches closer to a deal that would value the firm at $350 billion. And midterm anxieties rise for President Trump as the House passes a bill targeting his levies on Canadian imports. So futures are pointed higher today. Now, yesterday we had another AI rolling scare. This time it was real estate stocks. The previous day it was wealth stocks. Every time an AI tool gets rolled out, the whole industry seems to decline. We did have a positive session in Asia, though, and maybe the market is moving on and from these scares. But we are seeing a very definitely positive futures session. Now, yesterday the S&P was unchanged and the Nasdaq was up 0.3%. So these sessions are being capped by whatever the current AI story is. Let's take a look at the bond market because, of course, the payrolls report is really what's in focus as well. It was stronger than expected, but was it really enough to change minds at the FOMC? We're back really into the range that we've been at. The curve, albeit flatter. We're at about 66 basis points on the 2-10 spread now, with the 2-year yield at 350 again, the 10-year yield just below 416, and that 30-year yield below 480. Not a whole lot happening with metals, but we are seeing gold continue to stay above $5,000. All right, we'll get into all of this in just a few moments, but first let's get to some individual movers. For that, we'll go over to London and Abir Abu Omar. Abir.
Hey, Vonnie, we're sticking with the AI story this morning, starting with Cisco, which is pretty down this morning in the pre-market, almost 8%. And why? Their results yesterday that came out post-market suggested that the sales were good on the AI outlook, but their margins are really hurt by this crunch, this unprecedented crunch in memory chips. So that crunch and Cisco is obviously a user of those chips. That crunch has sent prices skyrocketing, and that's been affecting what we're seeing in the stock this morning. Although the company did say that they're handling this shortage better than peers. And again, sticking with the AI trend, we turn to AppLovin, another stock that is down this morning in the pre-trade, almost 5% down. It spared some of those losses from earlier, but it's really suffering from the AI boom. It's been painted as one of those stocks in the laggards basket of AI. It's down 30% so far this year, and we're seeing that investors are not taking kindly to the results from yesterday. Finally, we turn to some good finance, good old finance with Schroders, which is trading this morning in London, up almost 30%, and that's on the back of the Nuveen deal that we heard about this morning. Vonnie, we had an interview with the CEO who said that the UK will remain a key focus for the combined asset manager, but the majority of the AUM will be in the Americas, over 50%. Vonnie?
Yeah, lovely move there for Schroders. Abir, thank you so much. We'll chat to you again later in the hour. That's Abir Abu Omar. Also coming up this hour, more data on deck this week. We're going to take a closer look at the economy with Priya Misra of JPMorgan Asset Management. So traders pushing out bets for a first rate cut this year after that stronger than expected jobs report, now seeing a first cut in July. Kansas City Fed president saying that the Fed should hold rates at a, quote, somewhat restrictive level, adding that further rate cuts risk allowing high inflation to persist even longer. Bloomberg's Ven Ram joins us now for more. So Ven, is the economy in good enough shape, and can we tell from just that one jobs report for the Fed to wait literally a whole 7 months for a first cut?
I would definitely say so, Vonnie, because the jobs report was pretty strong and it laid low the claims that, this is a low fire environment. If you juxtapose the strong jobs report together with the productivity gains stemming from AI, it kind of suggests that the US economy has got plenty of momentum behind it. Now, should you be cutting rates into that environment? Now, the Fed thinks that the economy is going to grow 2.3% this year, with core PCE at 2.5% this year. Those inputs mean that the Taylor rule rate is suggesting that the Fed funds rate should be 3.75, exactly where we are now. So where is the room to cut rates, especially if the economy is going to overshoot in terms of growth and inflation also staying much above 2.5%, the Fed's inflation target. So there is no wiggle room for rate cuts here, and which is why you hear Fed speaker after Fed speaker say that there is no room for rate cuts. We are already at neutral. Any more would fan inflation. So it's definitely not the prescribed measure here.
Sure, but then were those fears over the labour market that we had before the holidays, so at the end of last year when the Fed switched its focus really to the labour market side of the mandate, were they then misplaced? And can we tell that from just this one delayed job report?
Well, I mean, that's a fair question, but I think that on the whole, if you read the tea leaves in the economy, Bonnie, I think what you get, I mean, you can barely argue that there is a case for back-to-back rate cuts here. This is an economy that is firing well on all cylinders. Okay, we are in a low fire environment before we got this latest report. But so that kind of suggests that the economy may be cooling, the jobs market may be cooling, but there are productivity gains stemming from AI that can't be wished away. So I think that, the Fed has to err on the side of caution and can't be cutting rates and stoking inflation when it has already missed the inflation target for several years in a row now.
All right, well, we do get CPI tomorrow, and we did find out that wages grew pretty healthily in that jobs report as well. Ven, thank you so much. That is Ven Ram there of our MLive team. Turning to tech now, and Anthropic close to raising more than $20 billion in one of the largest startup funding rounds ever. Backers, including Peter Thiel's founder fund and D.E. Shaw, it would value the company at about $350 billion. Joining us now is Tom McKenzie, host of Bloomberg Tech Europe. Tom, in some ways it feels like we're back in the old VC era where people just didn't want to be left out of anything that might turn into, the next, what used to be a unicorn, right?
Yeah, Vonnie, and to the extent that they don't want to be left out, you're getting investors who invested in two major competitors at the same time. You've got OpenAI, so some names on that list, on that cap table for Anthropic, also on the cap table of OpenAI, two fierce competitors, of course. So that speaks to that desire, as you mentioned, to not wanting to be left out in terms of the developments and evolution that's coming through. So Anthropic, $20 billion, that's according to our reporting in terms of this latest fundraising deal, valuing, as you said, the company at around $350 billion US. Just for size and scope and for context, that puts it above in terms of market cap. If you're looking at Netflix, it's a similar kind of market cap to Netflix. The market cap of Netflix similar to that level of valuation. It puts it above the market cap of Goldman Sachs, significantly above Disney. So that's the kind of size we're talking about in terms of the value of this company now. So yes, we had Peter Thiel's VC fund backing this, one of the co-leads, but also you had Cotu, you had MGX, and another other significant names getting behind this deal. And this, of course, after a really significant spotlight on the Anthropic, with the latest model coming through, very much focused on the coding space and on the financial space as well, financials and engineering, and on the back of this plugin that really disrupted the legal sector. And so Anthropic has been getting a lot of headlines. Now it's racking up this additional investment. And again, there has been reporting suggesting that this is a company that's looking to IPO at some point this year. It seems they're finding no trouble, at least, raising capital in the private markets.
Well, bets in these types of companies, in this case OpenAI, seem to be paying off. At least they did for Masayoshi Son. SoftBank swinging to a profit on the valuation boost from OpenAI. But it's very tethered to that now, right? It's very tethered to the success of ChatGPT, essentially.
It absolutely is. Look, we're talking about the quarterly earnings of SoftBank, and central to that was that stake, about 11% stake that SoftBank now has in OpenAI. It has sold down its stakes in NVIDIA. It's under a bit of pressure because it has 90% stake in ARM, the semiconductor maker, of course, or at least designer of those platforms. And that company is under pressure. But it is the OpenAI story that's paid off for them in the most recent quarter. They came through with a profit. It was actually a miss versus the estimates, but it's the fourth straight quarter of profits. And year on year, you were looking at a loss, and now they've turned to profitability. So that's positive. The gains from OpenAI in that bet, around $20 billion in terms of the value of their stake right now and the increase that they've seen on OpenAI. And SoftBank are in talks, according to reporting, to potentially put another $30 billion. They've also already invested about $30 billion US in OpenAI. They're looking, according to reporting, to invest potentially another $30 billion in OpenAI.
We got some more positive comments about the AI industry, if you like, if you can call it that, from Siemens, the CEO, saying, look, essentially, industrial demand is off the charts. I mean, how is Siemens benefiting from this that the likes of, say, Cisco is suffering from because Cisco can't get enough memory?
Yeah, so I was speaking to the CEO, Roland Busch of Siemens, about this. You can see the share price reaction there. So investors welcoming this news. And they have really benefited from shifting away from industries like the auto sector. They still see challenges there to really focus on the data center, on the electrification story, on the design software story as well. They've been quite acquisitive in terms of buying design and industrial software companies. And I asked the CEO whether he's concerned about AI disruption in that space. He said absolutely not, because of the complexity of that kind of software. He thinks it's very, very defensible. But the key takeaway was that they are seeing this massive demand, huge backlog, in fact, for the build out of data centers. They have a lot of skin in the game on that front, and that really is driving momentum for Siemens, both on the software front, but also on providing that electrification for the data center growth. And he said the US market is looking very strong for Siemens.
We'll have to take a look at that Siemens interview once again. Tom, thank you so much. Great interview. Bloomberg's Tom McKenzie. And do tune in to Bloomberg Tech Europe with Tom as he takes a deep dive into quantum computing. That's this Friday. In Europe, Schroders surging in London as Nuveen set to buy the asset manager in a near $14 billion deal. Bloomberg spoke with Schroders CEO Richard Oldfield earlier.
What we are doing here is creating this powerhouse of asset and wealth active management. It's going to have an unparalleled breadth of public to private capabilities. And at 2.5 trillion, it gives us the firepower to actually invest in our business and make ourselves more relevant to clients.
Joining us now is Bloomberg asset management reporter Leo Kenscherper. So thanks for joining, Leo. What do these companies have in common, and what will be additive to the combination?
Good morning. Yes, so I think it's fair to say that these are two companies with strong legacies. So Schroders was founded more than 200 years ago, one of these big City of London institutions. And you also have Nuveen, which was founded in the 19th century. So the companies were really keen to tout that. Schroders' issue over the past 20 years has been that they haven't been able to build that scale in private markets that they really that they really needed to become a one-stop shop, for institutional investors. And this is where Nuveen comes in. Schroveen, as one of my editors has called them earlier, will have about 17% of combined AUM in private markets, and overall the group together will have 2.5 trillion in assets under management, and this, puts them in a position to rival players like Capital Group, for instance, which is the world's largest active-only manager.
Yeah, I mean, and it's a phenomenal premium for Schroders as well. Was Schroders undervalued, or what's the story? Why the 30% move up to the deal price?
Yes, exactly. So the share price hit an all-time high in 2021. That was the post-COVID liquidity, post-COVID boom. But since then, it's been down roughly 25%. And so this premium, I think 29% to yesterday's close, sort of reflects that. So it's not I wouldn't say it's a massive premium. It's just, you could argue, if you were on the board of Schroders or if you were a shareholder, maybe should have done this deal 4 years ago.
Yeah. Leo, what else should we be looking out for in terms of deals in that space? Any more huge ones potentially on the horizon?
Yes, so anyone you ask in financial services deal making will confirm that, US asset managers are increasingly looking at European players and UK players in particular, because they trade at a slightly larger discount. So now who's left here in the UK is Aberdeen. They still manage around 500 billion in assets, and there have been various rumors, at least over the past few years, about them. There's also Man Group, which is more of a hedge fund player. They're also London listed, and of course you've got slightly bigger players in Europe, DWS and Amundi. Similar size to Schroders, DWS in particular, but of course they are still very much digestible for a larger US player.
Yeah, absolutely. Fascinating space. Leo, thank you so much for joining today. That is Bloomberg's Leo Kenscherper. Now to other top stories trending on the terminal this morning. The Republican-led House has passed legislation aimed at ending President Trump's levies on Canadian imports. The vote is the strongest political blow yet for the president's tariffs policies and signals growing anxiety over his economic agenda ahead of the midterm elections. President Trump is almost certain to veto any bill. The US and Japan are closing in on the first 3 projects to be funded by Tokyo's $550 billion investment vehicle. The projects are part of a bilateral trade deal, and sources say the 3 considered finalists in a review process are related to a data center, a deep-sea oil terminal in the Gulf of Mexico, and synthetic diamonds for semiconductors. And Morgan Stanley boosted CEO Ted Pick's pay to $45 million in 2025 after a record year. That's a 32% increase over the previous year, Pick's first at the helm. 3/4 of the bonus will be deferred over 3 years. Coming up, Hermes says strong sales were in line in the quarter, and it's all thanks to the Birkin bag. More on how the French bag maker remains one of luxury's most resilient players next. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York. Shares of Hermes are rising after demand continues for its coveted Birkin bags. The French bag maker is one of the industry's most resilient players as it caters to the most exclusive clients. Joining us now is Deborah Aitken, senior analyst at Bloomberg Intelligence. So a fantastic quarter for Hermes, but it wasn't thanks to perfume or beauty or anything like that. It was really all thanks to the Birkin bag, Deborah. And my first question would be, is this because people are buying an investment? Or is it genuinely that they have dollars to spend on luxury items? Because they would be very different reads of the US and foreign consumer.
Hi, yeah, it's very much domestic driven, and it is by those individuals who generally own more than one of the product within the brand range. You know, and actually we've seen the Birkin bag, yes, still very strong. Other brands and styles strong too. But now leather goods is 45% of sales. It used to be 55%. So also for Hermes, there's quality within homewares, ready-to-wear, jewellery and others, which are also driving this growth. So we saw growth 1Q 7%, 4Q 10%, so some momentum building.
How is Hermes dealing with the global tariff environment and just this turn inwards on the part of many countries now? Can it, get the raw materials it needs, get the labour it needs, and still keep those margins healthy?
So very vertically integrated, that's one of its core strengths, a major core strength. It's artisans. It takes on around 250 new artisans a year. It adds 1 production factory per year. And what it did last year, particularly for the US, we saw high single-digit pricing. Generally, across the board, it's 5 to 6% pricing, which they'll carry through into 2026 as well. And for it, and why it stands out versus its peers, its premium valuation, is because that helps it absolutely to not only manage margin, but to grow margin. So we actually saw operating margin up over 100 bips, beating consensus very nicely. Gross margin up over 100 bips, beating consensus nicely. Operating margin up as well, and carrying through what it did on the net on revenue to the EPS line, despite those tariffs, the extra surcharge on corporation tax in France, headwinds from currency and others. So that's a very solid set of results.
Hugely impressive performance. Deborah, what about L'Oreal? Because we get results from L'Oreal later. A little bit of a different consumer, but what should we expect?
Yeah. Again, momentum from 1Q through to 4Q. So the market generally is looking at just over 6% sales growth, like-for-like sales growth in the 4Q. We're hoping L'Oreal will come through and give market growth projection for the whole beauty market of around 4% this year, 4% plus, which would be a little bit better than 2025. 20 bips operating margin improvement, which is typical for their model, and that we're expecting to see Lux come back. All these companies have big exposure in Asia. China duty-free would still be a drag, but China domestic should be rebuilding. Luxury over there rebuilding. Derma globally rebuilding. And actually the biggest growth is set to come from around 7% from the US. Wow. So we're looking at them doing very well in premium in the US and holding their own in mass.
All right, Deborah. A nice quarter for some of these players. Thank you so much, Deborah Aitken of Bloomberg Intelligence. Coming up, AG Pam Bondi under fire over her handling of Epstein in a congressional hearing. More on that. And what else is making headlines in your front page news next? This is Bloomberg. Now for your front page news. And first up, the Washington Post leading with Attorney General Pam Bondi defending her leadership of the Justice Department before House lawmakers. She testified before the Judiciary Committee, where she was pressed on her handling of the Epstein files and prosecution of President Trump's political foes. The Post says the hearing comes at a critical time for the Justice Department. Next up on the Wall Street Journal, the Pentagon has told a second aircraft carrier strike group to prepare to deploy to the Middle East. This as the US military readies for a potential attack on Iran if negotiations fail. US officials caution that President Trump hasn't yet given an official order to deploy the second carrier and that plans could change. And finally, the Financial Times reporting Microsoft is pursuing true self-sufficiency in AI by building its own powerful models and reducing its reliance on OpenAI. This according to an interview with Microsoft AI chief Mustafa Suleyman. Do stay tuned. We're going to be speaking with Priya Misra of JPMorgan Asset Management next. It's 5:30 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Traders paring back rate cut bets following that payrolls report. Jobless claims up next. Stocks recovering from another AI scare trade, while Anthropic inches closer to a deal that would value it at $350 billion. And midterm anxieties rise for President Trump as the House passes a bill targeting his levies on Canadian imports. So let's look at those futures, all in the green after a flat day for the S&P 500 yesterday. The Nasdaq 100 was up just 1/3%. Those gains capped by the latest AI scare trade. It was real estate yesterday. We did have a good session in Asia overnight, though, setting the tone a little bit today as well. And of course, the payrolls report, which came in better than expected. Let's look at bonds because we have a bit of a flatter curve. 66 basis points now, the 2-10 spread, 350 on the front end, 479.81 on the back end. I do want to point to Yardeni Research today coining the whole AI trade AI-phoria or euphoria, but also admitting that it's taking no prisoners, and that's indeed what we're seeing in corners of the market. But does it all play out in a week? Or does it take longer than that? Well, we'll see. Let's get to some of those stocks, though, moving. Let's get to London and Abir Abu Omar. Abir.
Good morning, Vonnie. We're focusing on the winners and losers of the AI trade, starting with Cisco, which is not really having a good morning in the pre-trade, down almost 8%. Now, why is that? Their results were not terrible yesterday, but the stock is really hammered by this crunch in memory chips that is sending those prices soaring. But the CEO did come out and he said that although, the memory chip crunch is weighing on the stock, it is set to benefit more, or it's set to do better than peers that are struggling with the same issue. Turning to another stock, Vonnie, that is doing incredibly well this morning, we turn to Fastly first. So Fastly is one of those stocks that are benefiting from the AI boom. Essentially, what the CEO has said is that as we turn into this year, 2026, Fastly is going to be one of those companies that is really benefiting from the tailwinds of AI. So we speak a lot about, the macro picture when it comes to artificial intelligence and disruptions in different sectors. But Fastly is one of those winners of the AI trade. And finally, already trading Schroders. And Schroders was up more than 30% this morning. It's pared down some of those gains, but still massive increase in the stock. And that's on the back of some good M&A news. It's being acquired by Nuveen for a deal that is worth almost 10 billion pounds or $13.5 billion. So the stock is rising on that news to create one of the biggest active asset managers in the world. Vonnie?
Abir, thank you so much for that. Much appreciated, Abir Abu Omar. Investors are now looking ahead to jobless claims and CPI data after getting past yesterday's NFP report pretty unscathed. JPMorgan Asset Management's Priya Misra still concerned about the labour market, writing, quote, "We continue to characterise the job market as a low hire, low fire one, despite the higher than expected payrolls on Wednesday. Labour market's a bit fragile in terms of hiring trends and breadth." Priya joins us now. Priya, Why are you still concerned about it when nobody else seems to be that concerned about it, including the Fed, which was before the holidays and seems to have forgotten about what might be fragility in the labour market?
Sure. So I think we've had a lot of data. There's, right from whether it's ISM employment that looked like it was sort of stabilizing. The Fed's already cut a lot. So I think the Fed is hoping that the labour market is stable. We do think it's sort of stable, but it's stable at a low level. You look at whether it's household surveys, whether it's business surveys, hiring numbers are still weak. And then, yesterday's report was good. But when we look at that breadth of hiring, it's really education, it's healthcare. We're getting older. That's sort of a secular trend. It's not clear that we're sort of seeing this upswing or any sort of re-acceleration. So in our view, we're in this low, higher, low, higher. But I think we're one number away from, nervousness again. If you see initial claims pick up, if you see another challenger job survey picking up, I think the market will get nervous that if we're transitioning from a low, higher, low, higher to a low, higher pick-up in firing, I think then the market gets really nervous because I think the market wants to move on to this broadening, this broadening out of the recovery, the fact that, maybe we're sort of re-accelerating with the tax refunds. And I think that then starts to become a question. So I would say we're stabilizing, but we're not re-accelerating.
Was there anything else, though, that gave you a little bit of hope in the report? So we saw wage growth, for example, and it came in better than expected. Now, is that because inflation is a problem and employers are forced to give these wage growth numbers, or is it just because the economy is healthy and they can?
So I think wages, again, average hourly earnings was picking up, but if you see ECI or the employment cost index, which we got earlier in the week, that was actually weaker than expected. So I would again say we're getting like mixed data signals even on the wage front. Overall, though, and we're going to get CPI on Friday, so we're going to be looking at service inflation. Overall, our sense is, yes, inflation's above target, but a lot of those trends, whether you look at shelter inflation, ex-shelter service inflation, they are sort of heading lower. I think that's what will give comfort to the Fed. We do expect rate cuts later this year, and I think it's going to come from inflation. But I agree with you. If wages start to pick up, then maybe there's signs that the slack in the labor market's going away, that is getting tight again. The Fed's going to be watching that. So that was a sign of, maybe the slack being less, but I would say I'm not convinced that essentially wages are picking up.
If there is fragility under the surface and it just hasn't popped out in the data yet, then can we really wait till July for the first next rate cut?
I think the market's pricing in July because the market's looking at the inflation side. And it's going to take some time because we're going to get, some of that tariff-related inflation show up in the data. We don't expect CPI to get closer to 2.5%, until the second half of the year. So to your point, if the labor market stays okay, we stay in this low, higher, low, higher, I think the market's okay with second half of the year rate cuts. If we see a rise in initial claims and we start to see a pickup in layoffs, I think then the market's going to price in sooner cuts. It feels like the market's somewhat on edge. With every data point, we're moving things around. But I would look at the 10-year, and that's where there was nervousness, whether it was Japan-driven, sell America. Look at the 10-year. We've been in this very narrow range, 375 to 4.25 for a while. They tried to break out. I think the fundamentals of the economy don't argue for much higher rates. So, I think that range is fine. It's telling you that maybe we stay in this K-shaped, soft landing economy, and I think we don't need rate cuts for risk assets to do okay, as long as the labour market stays
So is this a potential scenario that plays out? Labour market fragility shows up little by little over the next few months as we get sort of on-time data. In the meantime, we get the process where Kevin Warsh is potentially the next Fed chair, and that's going to be in the second half of the year as well. And inflation doesn't rear its ugly head as much as maybe some had been thinking. And it all works out beautifully for 2 rate cuts in the second half of the year, and we're fine.
Great point. We do have a leadership change at the Fed, and we know that potentially, Kevin Warsh is going to talk about, potentially cutting rates some more in the front end. But I would argue he's got 1 vote at the committee. There are 12 voting members. He's going to have to get the committee on board. I think for more rate cuts, or even any rate cuts right now, he's going to need to see it in the data. I think the rest of the committee is going to want to see inflation heading closer to that 2%. I don't know if you're going to get to 2, but I think even 2.5 broad-based disinflation, I think, can get the committee on board. I know Kevin Walsh has this productivity thesis, but productivity is one of the hardest data points to actually measure. It's a bit of a residual. I don't know if he's going to be able to get the committee on board to cut, but in the second half of the year, I think you can get those rate cuts. The market's really nervous about the balance sheet. I think he's going to have a harder time there to either convince the market that, the balance sheet can be shortened, reduced, or even getting the committee on board, because the committee is increasing the balance sheet. I think rightfully so. Banks require those reserves. The balance sheet's not growing because of, the Fed is trying to help asset prices. It's providing the reserves that is required for the plumbing of the banking system.
Priya, what's looking interesting to you across the bond universe? And I'm not just talking about treasuries or other sovereign debt. I'm also talking about, credit and so on. Is there anything that's looking, like it might be the time to jump in and get some of it for your core bond portfolio?
Great point, because we are seeing a lot of opportunities. So when the market's sort of edgy and there's a lot of supply, we've had a lot of credit supply. Overall, we've seen still continued inflows into high quality credit and dispersions picking up. So I think this is the time when you have to do the work, make sure you understand where are the companies with a good, free cash flow coming in, lower leverage ratios, and we're finding high quality credit, whether it's in the investment grade space, whether it's even, high yield. The double B, single B part of the high yield market, which has widened a little bit, we're finding value there. Securitized credit, another area. So I would say credit, as long as the recession risk feels low, which we still think, even if the labor market is fragile, we're not in recession territory. So that's the time when you want to own credit risk, you're picking up spreads over treasuries, and then we like the hedge of owning some duration, owning some curve steepness. It provides the hedge that if you get one data point that gets the market nervous about the economy, interest rates will work, even if spreads widen a little bit. So I think owning that diversified portfolio of high quality credit, some duration, I think that's how we're positioned, and we feel confident if the economy stays as we expect, we're okay, we pick up yield. And if not, we've got that diversification from treasuries.
Something for all eventualities. Priya, thank you so much. Always love having you in studio with us. That is Priya Misra of JPMorgan Asset Management. Now to other top stories trending on the terminal this morning. Nuveen buying Schroders in a $13.5 billion deal, creating one of the world's largest active asset managers with nearly $2.5 trillion in assets. The Schroders brand will be retained, and London will serve as the combined group's non-US headquarters and largest office. Sanofi shares are plunging after abruptly pushing out its chief executive. CEO Paul Hudson boosted research spending, which failed to deliver rapid results. Merck Group CEO Belén Garijo has been appointed as Hudson's successor. And the Waldorf Astoria on Manhattan's Park Avenue is coming up for sale following an extensive renovation. Sources say that real estate investment bank Eastdale Secured is expected to bring the hotel to market on behalf of its Chinese owners. The hotel reopened last year to wide acclaim and high room prices. Coming up, midterm anxiety grows. More on the latest rebuff to President Trump's economic agenda. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York. The House has passed legislation aimed at ending President Trump's tariffs on Canadian imports, adding pressure to the Trump administration agenda just months ahead of the midterm elections. Joining us now is Bloomberg's David Gura. So, David, it is a rebuke, obviously, to President Trump's agenda, but does it go past this? It's never going to become law, right?
That's exactly right. So I think it's easy to say this is a symbolic victory here for Democrats, but they were able to pull over 6 Republicans to support this legislation that had been in the works for almost a year now. Gregory Meeks, the ranking member of the House Foreign Affairs Committee, introduced this law, pushing back on the national security justifications that the president has used here. And we've seen House Speaker Mike Johnson over and over again trying to make it so this legislation wouldn't get to the floor of the House of Representatives. It did, and you had these 6 Republicans crossing over. I think it's important to look at that as an indication that there are some Republicans, some of whom are close to the Canadian border, whose districts do a lot of business with Canada, who are pushing back on what the president has done here when it comes to trade policy. I think the broader takeaway here is the midterms are looming. There is growing dissatisfaction and anxiety among the American electorate about the state of the economy and where it's headed. There's some doubt about the president's trade policies, and you're seeing that kind of manifest in the way that this vote turned out yesterday. I should say also there's a bit of political geography at play here. Yes, this happened on Capitol Hill, right across the street at the Supreme Court. The justices there are weighing some of these same issues. Could the president do what he's done here, using national security grounds to justify the implementation of these tariffs? We are still waiting for a decision from the justices that could come in just a few days' time, Bonnie.
Yeah, exactly. Well, David, you make a good point. You know, it seems like maybe voters are prompting this to some extent because they're obviously pushing their representatives or expressing their feelings, and the representatives are then obviously passing that on. But at the same time, does it mean that President Trump might change his mind or do something differently on USMCA, or really dig in on an agenda he thinks works?
Yeah, Bloomberg reporting that the president is having doubts about the USMCA, which is up for renegotiation, maybe expressing thoughts among his inner circle that it's not something that he wants to continue going forward. Of course, that would be alarming to Canada and to Mexico as that process has begun in earnest with hearings and comment periods. Look, he's aware. His advisors are telling him that affordability is the issue that voters are caring about going into these midterm elections. And we have seen over the course of the last few months the difficulty with which the president's engaged with that issue in speeches and in interviews that he's done. He's doubted that affordability is an actual salient issue for a lot of voters. But we know, based on polling, based on sentiment data, it is something that voters really care about. Will it change his perspective on trade policy? I doubt it. We saw this threat from him on social media last night to any Republicans who dare cross him when it comes to the tariffs issue. But it is something that I think he's having to reckon with, the fact that this is something that voters very much care about, Bonnie.
He will have been very pleased with yesterday's non-farm payrolls report, a positive surprise. It also gives him some leeway when it comes to the immigration argument. Potentially, David, is the administration making hay from these numbers?
They are. We saw their reaction to it. Again, I cite his social media posts. He was very happy with the jobs numbers yesterday, as you might expect, and certainly is with merit. These are much better numbers, of course, than Wall Street and others expected. But you look at that in the crucible of what he wants to happen policy-wise, and the person who you were just talking about, Kevin Warsh, nominated to be the next Federal Reserve Chair, talking about cutting rates. All of that greatly complicated by the fact that we have this good number, this good job number yesterday, and we're looking ahead to the new inflation numbers later this week. Yes, there still remains this expectation for 2 cuts this year. How that could change, though, based on the quality of the data, the goodness of the data, to coin a term, I think is something that he's having to sort of navigate as well.
David, thank you so much. That is Bloomberg's David Gurria there. Turning to the latest in AI, Anthropic's funding round, the most recent one, close to raising more than $20 billion with backers, including Peter Thiel's Founders Fund and D.E. Shaw. The deal would value the startup at about $350 billion. Joining us now is Bloomberg's Neil Campling. Neil, I mean, with every funding round, obviously, its valuation goes up, but are we hearing echoes of the old VC times when, you know, anybody would fund anything just to be involved in the exit?
It's an interesting question that you pose. I think what it is these funding rounds we're seeing are for some of the biggest AI models that are out there. So often they are the same backers for these particular technologies, and really it's betting that you're going to make more returns from betting on a number of these systems by choosing sort of 1 or 2 or 3 winners. And I think interesting here is that a lot of the OpenAI investors, and we've seen Microsoft, Nvidia talked about in the articles as well as being investors, have also invested in OpenAI. So it's not just purely on betting everything on one system. There's a number of winners that will emerge clearly from this particular AI trade.
You know, we're talking about companies that have a certain number of products, right? We're talking about ChatGPT, we're talking about Claude. I mean, if you take the pharma industry, for example, they have to come out with a drug and then they have to keep coming out with more drugs or their share prices plummet. We are seeing that, regularly. Are these companies going to have to prove themselves? Is there too much betting on just, 1 or 2 products?
I think what we are actually doing now is moving on from the original AI 1.0, if you like. We move from the large language models now into the AI, the agentic AI, the AI agents, where you are training for specific purposes. You're seeing this in what happened with software last week, when people realized that there are solutions you can create for certain areas, whether it's the wealth managers or whether it's other pockets of the market. So you have to provide not just a broad spread, but clearly with these different models, you require a very specific solution to a specific problem. And they are now much cleverer in terms of the predictability. than we had from some of the what they call the hallucinations, the errors these models presented even just a year ago. That the technology has come on immensely. But certainly, as with every single technology wave, two things are certain in terms of technology is in effect deflationary, which is a positive thing. And the second thing is that there are a handful of winners in every tech cycle. But there are also many victims that come about from this.
Neil, Anthropic has a revenue run rate of $9 billion, right? It's not nothing, but at the same time, will it be kind of rushing to the IPO exit in order to give some of these investors an exit, just in case something happens and the world stops believing in the AI train?
It's a great question. It'll be interesting to see, you would normally expect a larger scale in terms of the revenue run rate before you're coming public. And if they are investing at these kind of rounds currently, I suspect because of the appetite for this deal, this particular one is a who's list of potential investors. So it suggests perhaps that they've got no problem in funding. So while there is no problem in funding, there's no need to rush to the market. There's no need for them to be scrutinised as a public company, which is a different level of scrutiny than you get being in a private market. So I wouldn't expect an IPO anytime soon for Anthropic.
Fascinating. Neil, we had real estate services stocks sinking in the latest AI scare trade, waking up every day now just wondering what's going to be next. But it's spread. It's not just the United States. Europe is also now in the crosshairs.
Yeah, absolutely. And we're seeing this. We saw this yesterday, as you mentioned. CBRE is a good example, was hit double digits yesterday. Now, what's different in this particular example is it wasn't because of a new agentic AI that was launched. It was just fear that there could be one launched. So we're now getting to the realms of not just the release of an agentic that's then impacting stocks. We're now predicting where we might see the next one and the disruption that could take place in the future. It's an interesting point is that CBRE itself is due to have earnings in about an hour's time. And clearly they're not going to have seen an impact yet in those numbers, but you can guarantee the analysts are going to question them on the call as to what they perceive the risks to be long term from the risks and opportunities of AI.
Absolutely, yeah, there'll be a lot of preparation going on for that call, to say the least. Looking forward to it. Neil, thank you so much. That is Bloomberg's Neil Campling. Coming up, we're going to get you set up for your trading day with more earnings and economic data on deck. This is Bloomberg. Now, a look at what's ahead today. First up, initial jobless claims, 8:30 Eastern, followed by existing home sales at 10. Earnings after the market closed from Applied Materials, Airbnb and DraftKings in focus. And more Fed speak. We'll have Governor Stephen Miron and Dallas Fed President Lori Logan at 7 p.m. Eastern. Some of the pre-market movers, Cisco extending its post-earnings decline after that tepid margin forecast. Memory chip pricing a problem there. AppLovin, it's the fourth worst performer in the Nasdaq this year, even though it beat in results and its outlook, being hit by AI disruption concerns once again today. And Rollins down 14%, revenue missed estimates there. It's been caught as well at Wells Fargo. Price target at Wells Fargo is exactly here, 56. Let's take a look at the macro picture before we head into our Thursday trading session. Futures pointed higher, a little bit of relief potentially today, tiny bit of weight to the dollar index, and your 10-year yield really going nowhere below 417. That's it for Bloomberg Brief. Surveillance is ahead. This is Bloomberg.